What is up, you guys? Pete DiCarlo here, and today we're going to do something a little bit different. Normally on this channel, we talk about the stocks that I'm watching, why I'm watching them, and I go over some free trade ideas. But what I wanted to start doing is adding some videos on actually how to trade and answering a lot of the questions based on trading style and things I do and just overall market questions. I do have a free Discord. You guys should go ahead and check it out below. There's tons of free courses, free resources, a great place to hang out and trade with. And I asked them, what are some questions that you want me to go over in some videos? One of the biggest questions that I got was actually about how to fill on options and slippage. So what we're going to talk about in this video is slippage, why it's so important, and how it really screws a lot of people, and how to fill on your options basically instantly. So hit the like button, subscribe, hit the notification bell, go ahead in the link in the description and go ahead and follow our free Discord. It's completely free. Like I said, tons of resources there. So one of the main things when it comes to trading options is going to be your bid and ask. And this is going to be called your spread. This is extremely important because a bid ask is really what someone's going to buy it for and what someone is going to sell it for. You have to think of this like an auction. The options market, the stock market, all of this is like an auction. There are people who are saying, I will buy a certain stock or a certain option for this price. And then there are people who are saying, I will pay a certain price for this stock or option. And then normally they meet in the middle. It's kind of like if you've ever seen Pawn Stars and somebody comes in and like, I have this, rare coin and I want $1,000 for it. And then Pawn Stars guys like Rick is like, oh, well, actually, I'll give you 500. And they're like, no, there's no way that I'm going to give you $500. So what they're going to do is they'll meet somewhere within the middle. And that is normally what you will end up paying for whatever you're looking to purchase in the market. And so we will go over some examples. Now, the first thing that you have to realize is that that spread between the two is normally what you end up paying. So in this example, let's just use very even numbers here. Let's say the bid on the stock is, let's just say $100. So this is what somebody will buy the stock for. And now I'm going to show you with options. So someone's going to buy it for $100, but the ask, which is what someone's going to sell it for, someone is asking for $101 even. Keep these even numbers. And now between the two of them is called the spread. So if you wanted to just sell your shares as soon as possible, what you could do is just say, okay, whatever, like I'll sell them to you for $100, and then instantly you would close out your position. And if you're a buyer, you would say, okay, I really don't want to pay 101, but I can buy it right this second for $101. What I'm going to do is I'm going to hit the ask, is what we call it, and I'm going to fill. Now, if you guys have ever seen anytime, I don't know how long most of you have been trading, but there are a lot of different types of buy orders. There is a market order, and your market order means that when you do a market, it's just going to hit the ask. So if you're selling it, it's going to just hit your bid. And if you're buying it, it's going to hit the ask. Basically, when you use market, you're going to fill at the crappiest price possible, unfortunately. But you will have a ton of liquidity. You'll be able to get in and out of the market. Then a limit, which if I'm not trying to make this like a very basic video on limited market orders, but a limit means that you are only going to fill at the price you want. So let's say that, it's, people are buying for 100 and you're trying to sell and you're asking 101. You could say, I will sell this for $100.50 and I will not take a penny less. And then if somebody from the bid side decides, all right, I see an order for 150, I'll pay that, and then it'll fill and then your order will go through. And if that doesn't happen, if someone says, hey, I'm not paying that price, then what's going to end up happening is you're just not going to fill. And so bid ask happens a lot. It happens all the time, actually, whenever you're trading, or even if you're trying to fill on a long-term investment, you're always going to have bid asks. So it's very important to understand that. Now, when it comes to trading, there are going to be different stocks that have a wider or a smaller bid ask. So for instance, like if you're trading the S&P 500, you might see the bid be, I don't know what the price is right now, but let's just say $440.22. And then that's the bid. So that's what someone's willing to pay. And then the ask will be something along the lines of like 440, maybe 24. So the spread between the two of them right here is what? It's 22 cents. That's not bad at all. So, I mean, I'm sorry, it's actually 2 cents because that's what you'll normally see a lot. It's actually 2 cents. So that means it's 2 pennies right now. That is the difference between the buy and the ask. So if you're like, all right, whatever, 2 pennies is not a big deal. But there are some stocks out there with a lot lower volume, because volume is going to be the most important thing. Volume, I'm going to underline it like 4 times. Volume is extremely important for you guys, because the more volume that a stock has, the closer your bid and ask will be to each other. The further away the bid and the ask, usually the crappier the volume. So that is extremely important whenever you're looking to have liquidity in a position and fill on a position. So an example of that might be, I don't have a perfect example in front of me, but let's just say it's a company like BBIG. We're not going to use the exact prices here, but there's a lot of volume some days, and some days there's not a lot of volume. So let's say that the stock has low volume and the ask is like $10.22, and then the actual bid on the stock, what someone's willing to pay for it is or what someone's willing to sell it for. I'm sorry, the bid is what someone's willing to buy. The ask is what someone's willing to sell. Let's say that they're willing to buy for 10.22, but someone is hitting the ask or selling this for like $10.45. That spread is a lot wider, and that's where slippage occurs. So to give you guys an example of slippage really hurting you, and this is where it is the most important, is when it comes to options, because each one of these prices that we're going to be talking about is times 100. So let's say that you just want to get some calls, and you're looking at calls for 2 weeks from now, and the ask on those calls is, let's say, 45 cents. So we're going to have 45 cents on those calls, and we'll do 45 and then 45 cents. And then the ask on those is going to be 55 cents. And so you might think to yourself off the bat, like, oh, dude, 55 cents and 45 cents. That means right now we have a spread of what? 10 cents. That might not be that big of a deal to you guys. So 10 cents per contract is the spread. And when you try to like set an order on Robinhood or whatever app you end up using, or broker you end up using, it's going to tell you, okay, this is what you should put in. Sometimes you will see that when you go to fill with an option, it'll say like the spread is too far or the bid ask is too far, enter a number. This is what they're telling you to do, enter a number. You could just go through and you could be like, no, I'm just going to hit the lowest number, and then you could get filled instantly if you're trying to, sell a contract on the bid, but you're going to lose $10. Or if you're just trying to, buy an option and you're like, screw it, I don't care. You're just going to fill here on 55 and not care. This is why when I watch for unusual options activity, which is mainly what I do, there are some times where people will hit with millions of dollars on the ask, which basically means I don't care what the price is, I just want to get in. That is one sign of unusual options activity, which we talk a lot on this channel about. But in this instance, 10 cents may not seem like a big deal, but let's go ahead and remember that all of these numbers are times 100. So 10 cents times 100 is going to end up being $10. All right, $10, really not that big of a deal. But what if you're trading, I don't know, 500 contracts? 500 contracts with a $10 amount of slippage between these two is going to add up to way more money than you think it is. And the issue is when you're looking at something like Robinhood, for instance, most of the time when it says like you're up blank, like $20, $30, $40, $50, maybe even a couple hundred on your option, that is showing you most of the time not what you're going to be able to sell it for, but really usually what your ask is going to be. That's normally what it's showing you. So this is extremely important to see the difference between these. And this is why when I tell people to trade options that have a lot of volume. So when I'm looking at volume, I am looking at minimum 100 volume for the day. Minimum. Really, I want to see volume at like 500. If I can see volume at like 1,000 plus, that's really best case scenario in my opinion, because normally, like I said before, the higher the volume, the closer your bid and ask will be. So let's say that like maybe the volume on this was 10,000, and instead of the bid being 45 cents, the bid was 48 cents. Instead of the ask being 55 cents, the ask was 49 cents. Then you only have 1 penny between the two of them. When you have low volume, it is very hard to get in and out of a trade. And most importantly, the slippage that you see it ends up really messing with you. And most of the time too is you don't even see it because you don't even realize that all of this is going on when you're trying to fill on a position. So it's extremely, extremely important that you trade high volume. It's extremely important that you understand where the slippage is occurring. And it's extremely important that you have liquidity within the positions that you are trying to take in any of the options that you have. So, long story short, watch out for slippage. But the main point of this video, which I was trying to speak about earlier, is that really, if you want to fill automatically every single time on your play, all you have to do if you're selling is all you have to do if you're selling is hitting the bid, which means that if you're selling this position that you are just trying to get out as soon as possible, you'll sell it to whoever. You'll sell it to whatever this price is going to be over here on your bid. And if you're somebody who is just trying to get into a position and buy into a position, you're going to pay whatever the seller wants, so you're going to end up hitting the ask. Now, I don't recommend doing this all of the time because, like I said, at the end of the day, you could end up losing more money than you really think because you're filling on poor positions. But that is how you would get in and out as fast as you possibly can. Because a lot of times I get students who are like, hey, I'm not filling on a spread, or hey, I'm not filling on an option. It's because you might have to, there might not be enough volume for you to fill like between these, somewhere between the middle. So instead, you're going to have to hit either side. And especially if you're doing a put credit spread or something, which is what I really like to do, you're dealing with two different spreads and two different contracts. So let's say that like on this contract, the bid ask is 45 cents and 55 cents, but then maybe on one of the other contracts on your put credit spread, you have one that's like 33 cents, and then you have another one that is like 47 cents because this one doesn't have a ton of volume at all. Well, now you're doing this, as one order, but really you have two separate orders within that order. So you have to come to a common ground somewhere on this option and then somewhere on the other option. So this is what causes a lot of problems for people when they're playing put credit spreads or spreads in general, because a lot of times they're playing strikes that don't have a lot of volume, and then they're also going to be losing money with slippage between the two of those trying to get them filled. Overall, guys, I hope this video helped. So I'm trying this little whiteboard out thing with like this little pen and whatnot. So I'm hoping that this helped. I'm gonna make more videos like this, kind of just teaching you guys how to trade. And if you guys have any questions that you want me to ask or answer directly in video format, go ahead and become a part of the free Discord down below. And there's a whole thread and a whole section for areas you can ask me about, and different questions you can ask me. And if enough people like them, I'll do a whole video on it. Thank you guys, and I'll see you next time. Peace.